Is China going to kick the world economy while it's down? That's the question on our minds today. We, of course, heard central bankers come out of the forum in Sintra that the ECB is holding with all kinds of hawkishness on their mind, as we've been talking about, the concern around getting inflation expectations moving down clearly front and center. And of course, that continues to stoke a conversation about how much all of this translates into global recession risk. So the world economy can ill afford any more complications. Enter China. Welcome to Macro Money, everybody. This is Ilya Spivak, head of global macro here at tastylive, and that is what we are focused on today. We are going to see if perhaps this is a time when, just as global recession fears are getting a bit of amplification from the world's central banks, we are going to get a new headwind compounding the issue by way of Chinese economic data. Let's first take a look at what we have coming up, what is expected, how it might influence markets, and then how it all fits into this broader narrative, which collectively seems to spell bad news for any kind of growth sensitive, any kind of risk positive assets. Of course, I'm thinking about stocks, I'm thinking about growth-based commodities, and how all of that might then be a boon for the US dollar. So, first things first, what is it that we're actually expecting to see, and what is it that's coming out? We're going to get China's official PMI numbers today. Now, this is one of two sets of data on this. Out of China, you typically get not one, but two PMI releases. One is coming from the government, from the China Federation of Logistics and Purchasing, and the other comes from S&P Global and Caixin. The former is what we're talking about here. This is focused more on China's state-owned enterprises, so large companies in China. The Caixin one is more the smaller, more privately owned. Nothing is, of course, fully outside the reach of government in China, but Caixin focuses on smaller firms and more foreign-influenced firms than this. This is sort of core, and what it is that Beijing also, if you harbor suspicion that they might shade their economic data, what you would surmise they want you to see. And what we see here then is a slowdown across the spectrum. Third consecutive month of contraction in manufacturing expected. This is, of course, following the PMI convention. So 50 is the center line at which there is neither growth nor contraction. Below 50, the sector in question is shrinking. Above 50, it's growing. The further below 50, the faster it's shrinking. The further above 50, the faster it's growing. So what you're seeing here is slower growth in services, slower growth in the overall composite that includes both services and manufacturing because of that disconnect between the sectors, and manufacturing shrinking at a slightly slower rate, but nevertheless shrinking for the third month. So what seems to be the problem here? Why is China's storied reopening from COVID, why is it sputtering here? We, of course, saw a bit of a surge as the economy came online. In December is when these COVID restrictions were starting to lift and quarantines were starting to end. And so you see this sharp move higher here as the calendar turns to this year in service sector activity, you see that is pulling the composite with it. And now as that's receding, the composite is receding with it. Manufacturing, you can see, never really got as far and slipped into contraction territory far sooner. But the general dynamics here you can see broadly follow. So from about the beginning of the year, a lift, manufacturing crests by about a month earlier than does the service sector, but then both head lower. Both are now showing that the economy as a whole is receding, and these numbers lining up to show that no meaningful improvement has been achieved, certainly from the prior month or the recent ones. So why is China withering? Take a look. We have here the composite PMI numbers from China, both of them, as a matter of fact, the CFLP1 and the Caixin. You can see they follow closely together, as well as the composite PMI numbers from the US and the Eurozone, which are, not surprisingly, I would think, the largest sources of end demand for China's export engine. If China is kind of the middle of the global supply chain where raw materials start somewhere, be it Australia or Chile or somewhere in Southeast Asia, say, and they show up in China where the until recently abundant labor force is there to assemble these things into semi-finished or finished goods, ship them on, and this kind of intermediate goods manufacturing is the sort of essence of the economy, the driving force behind it. Well, then it makes sense. Then if China is the middle of that, the end demand is where the preponderance of rich consumers live. And that's the Eurozone and the US. So you can see here, China reopens December of last year. By then, both the Eurozone and the US have long since witnessed the cresting of their post-pandemic growth spurt. You can see both of them surging on the composite PMI numbers, with the peaks in May of 2021 and July of 2021 for the US and the Eurozone, respectively. That's, of course, a function of a giant wave of stimulus and also of the start of reopening. So that's where that catch-up growth crests, and from there, deceleration. And then, of course, at the same time, there is global tightening. By the time China reopens, global central banks led by the Fed are already almost a year into an aggressive tightening cycle. So not only is the end demand diminished by this receding dividend from stimulus, but you also have this very active headwind battering that demand lower. And you can see that in the evolution of trade volume. So you can see here as the Fed funds rate here, we're looking at the first Fed funds future as a benchmark, as that goes up here from early 2022, that of course starts its hike cycle in March of that year, you also see cumulative global trade volumes start to wither. That's total turnover there, exports and imports in US dollar terms worldwide. And you really can't miss the synchronicity here. So not only does China face an already slowing end demand sort of environment, that slowing is being made more pronounced because it is being actively driven lower, other than just receding after a sugar high on fiscal stimulus. And so you see that for China, that is translating into a parallel slowdown in both imports and exports, which at this point are now, the both of them, moving significantly lower and looking worse ostensibly in terms of their overall performance than even during the lockdowns. But it actually gets even worse. It's not just the loss of end demand. It's that since everybody reopened sooner than did China, and they spent nearly a year longer in lockdown mode, supply chains had to be diversified. We've talked ad nauseum, of course, about fractured supply chains leading in part to inflation, and that being the transitory part that has ostensibly fallen out already, which is how you get from 9% inflation to 4% inflation, for example, in the US. Well, that process took time, but of course it meant the adjusting of supply chains away from China, because so much of that fracturing was, in fact, China being closed at a time where there was rabid demand and a rabid pull then on those supply chains. So you can see that it's not even just that China sees exports and imports fall. It's that its share of global exports and its share of global imports is sinking too. Just 10% for imports and now just 12% for export. So a significant reduction. If you look at this as the overall picture, you can see that going back to the peaks here, China's overall share of global trade turnover has gone down from 15% to just 11%. And the trend has been unmistakable. You are at this point in relatively deep negative territory for the whole picture. Now, of course, this has come with the slowdown in overall global economic activity. You can see there's the year-on-year rate of decline in global trade volumes in general. But until very, very recently, China was slowing faster than even that. You can see the red line spending most of recent months, and in fact, most of the past 2 years or so, under the dark blue one, which means that the slowdown in China is happening at a faster speed than it is happening worldwide. And of course, the story about the share of that overall total tells exactly that tale. They were moving, at least with relative sync in terms of speed, then China's share would be holding closer to steady. So the external sector clearly significantly hampered. How much hope is there that the premium from domestic demand will hold up? That's been the hope so far. We've seen that, of course, as we look at these PMI numbers again, it's growing slower. It's decelerating alongside manufacturing, but it is growing. So can this at least hold up? Can we at least have a sense that domestic demand can find its footing? It's tough to say exactly, but we can get a sense of it looking at some high-frequency data here. This is an average of metro traffic volumes in the top 5 cities in China. So what we've done here is we've taken average metro traffic, we've averaged that across 5 cities, and then we've taken a 20-day moving average of the average to get a smoother sort of line here. Otherwise, it looks quite a bit like chop. There's a lot of volatility around this, of course, because what we're looking at here is people going from place to place in what is an incredibly populous economy. So you would need to smooth things out a bit to get a clearer sense. take a look and you immediately see what seems to be going on here. This is going back to about late 2019. So just as we started to get some sense that COVID was beginning to emerge in China, and right before it strikes the rest of the world. So you can see right here is COVID. So there's quarantines, metro traffic collapses. It then rebuilds, and you get into this idling right here. Just as China tries to reopen, you'll recall it actually reopened a bit sooner than everybody else, then closed right back up because cases started to surge again. And you see that here as well. Here is that second wave of anti-COVID measures. And then, of course, here we are at the start of the reopening. And you can see there's the surge. There's domestic demand from people coming out of lockdown. The metro traffic tells you people have left their house. They're out there consuming, moving around, eating in restaurants, so forth. And so you can see that it has rebuilt back to pre-pandemic levels here and then stopped. So what we're ostensibly looking at here is the end of whatever premium there was to have from pent-up demand while people were on quarantine. That essentially domestic demand in China has already normalized. And now it is a question of exports being missing in action. And the external sector in China is a much more important contributor to growth than it is in most Western economies. As of the pre-COVID period, we were talking about 40% of the economy. Now we're talking about around 30%, which is still commanding relative to something like the US or even a big exporter like the Eurozone, where Germany is obviously a major export powered engine and the largest economy in the area. So you have a situation here where domestic demand seems to have run out of runway. Meanwhile, the weakness externally persists and is more damaging than it would be, let's say, somewhere in the G10. This looks likely to continue, if only because global central banks don't seem to have lost any appetite for tightening. We can see that their efforts seem to be working. Global CPI here lagged 7 months to the decline in trade volumes, is in fact receding. The success that's been had in the US is, of course, a huge part of this. The UK, the Eurozone have had a harder time, but this sort of averages out everything together. And indeed, inflation has come off, as you can see, but it's still worryingly high. It's still nowhere in the 1 to 3% range where people would want it. You can see that in the pre-pandemic period here, when you average developed and emerging markets together, you're looking at inflation averaging, let's call it 3, somewhere between 2 and 4. The emerging market economies tend to run somewhat higher inflation readings, let's say closer to 4. Developed markets have been stuck around 1.5 for a while since the global financial crisis, give or take. Average that, and you're looking at about 3. Well, at this point, we're still north of 4, closer to 5, 6. And you heard that from central bankers in Sintra this week, because all they had to say was how much they wanted to beat down inflation expectations and how much they wanted to keep tightening. Indeed, if you look at an average of break-even rates, which are the bond market's expectation for where inflation is going, you can see that while global CPI is in fact pulling back, thanks to all of these central bank efforts, inflation expectations have stopped falling. And to the extent that they lead CPI by 6 months here, you can get the sense that perhaps CPI in its move lower is going to stall. It is going to stall higher than what central banks want to see, which then ostensibly suggests that they are going to keep squeezing, that they're going to keep turning these screws to keep the global economy from rebuilding these inflation expectations and working at cross purposes with what central banks want. What that means is that a recovery in Chinese export demand is probably nowhere on the horizon, at least in the near term. The markets have clearly caught on, because if you look at the rates structure, you can see that there's in the big dotted line the implied policy rate curve at the reopening. There it is a week ago in the short dots, and in the solid line is where it is now. You can see dramatic dovish movement in this curve. Even just over the past week, a significant number of rate cuts being baked in over the very near term, even just over the coming month. Still more easing expected thereafter, a bit of a strange hump in the curve here between the 1 and 3 month view. Perhaps markets thinking that China can do a burst of stimulus and then ease back off it. But nevertheless, the current picture, weird though it is, with that hump there, and it's not unusual to see a bit of near-term strangeness in Chinese rates, in so much as this is not an economy that has the normalizing influence of external capital flows. For the most part, mainland is closed to external capital flowing freely in and out, and so can get a little strangeness here. But the overall trajectory of expectations that this implies is unmistakable. The markets think that as global central banks push more hawkish, China is going to push more dovish, much more dovish. And the reason that they're going to do that is because it doesn't look like they have a growth engine that is able to be restarted here with any kind of significant boost to this economy. In fact, looking at economic data here, it looks like it is doing even worse than is expected, which ostensibly is already downbeat. This is a index from Citi tracking the performance of Chinese economic data relative to baseline forecasts. Those are typically something that come out of surveys of economists and market watchers from big data aggregators like, say, a Bloomberg or a Refinitiv, aka former Reuters. And you get this sense from those numbers what the cumulative view is, and everybody is busy now hand-wringing about the situation in China. There was a lot of optimism around its reopening since the beginning of the year, but for here on macro money, I should say. And certainly not the only place, but we were amongst the skeptics. Now that hand-wringing is widely spread, and still Chinese economic data is finding ways to significantly undershoot even those forecasts. So much so that the index is now below zero, which means that data is tending to surprise on the downside. And it's gotten here having been deteriorating since about mid-April of this year. So what we are left with then is a situation where we're already worried about the global economy slowing because central banks don't find they've hit it over the head enough times to get inflation where they want it to go. They've told us repeatedly, Fed Chair Powell loudest in the chorus, certainly not far ahead of similar loud, hawkish squawking from ECB President Christine Lagarde. They've said unequivocally, we're not looking at significant cuts anytime soon. We're going to keep rates higher for longer. This inflation has to come down. So there's already a recession worry. We already had a preview of what this looks like when abysmal PMI numbers came out of the US, the Eurozone, and the UK last Friday. Lower stocks, a stronger dollar, a deeper inversion in the yield curve, with front-end rates held up because of a greater expectation of policy hawkishness, the low end going down or kept anchored because capital is getting spooked and flowing into the safety of government bonds at the longer end of the breakdown. So you have a situation here then where if this is how Chinese economic data has tended to perform, and so the PMI numbers that we're going to see today, let's say, run a meaningful risk of missing and registering softer, then you end up with not just a recession risk that's already there, but a second round effect as well as an independent risk on top. Because, of course, China is largely suffering because they took so long to reopen. That's a domestic and a local risk that isn't likely to get resolved, and that scarring will keep the economy slow and compounding recession worries. That is made self-reinforcingly negative because the tightening is hurting the export engine and not allowing China to get off the ground, even if it wanted to, now that it's removed these barriers to economic activity that were holding it back. So as we get these numbers, if they veer soft, the risk of a global recession is likely to seem that much more acute. And with that, Friday's price action may very well be telling. In the wake of it, we may well be looking at significantly stronger U.S. dollar against likely cyclical currencies more than anything. Australian dollar certainly stands out on that list, but probably lower in a more broad sense against even currencies like the euro or the pound. You might also get weaker stocks. You might also get weakness in growth-sensitive commodities. Copper, crude oil certainly stand out. There's a bit of fuzziness in crude oil because of this war in Ukraine and its sensitivity to supply there. But copper certainly is a barometer worth looking at in this environment. And of course, you would also expect a deeper inversion in the yield curve. So better performance for bonds at the longer end, and perhaps even a degree of stumbling toward the shorter end. But with central banks as hawkish as they are, does not seem to be a whole lot of runway there. And that is Macro Money for today. Thank you very much for joining me. As ever, we're here Monday through Thursday, right after overtime, a show that I do with Chris Vecchio, head of Futures and Forex here at Tasty Live, where we look at the day's events and try to make sense of them. I'm also on with Chris for Futures Power Hour on Friday, on with Tom and Tony for First Call on Sunday, writing for tastylive.com, and opining on Twitter at Ilya Spivak. Macro Money will be back tomorrow. Thanks very much for joining. See you then. Take care.